All right, let's jump right into this explainer. Today, we're unpacking the actual data-driven blueprints that analysts are using to forecast the 2026 to 2027 crypto cycle. Look, if you've been watching the markets lately, you already know the era of pure Wild West speculation, it's over. We are in a totally different game now. Today, we're zeroing in on the rigorous mathematical supply constraints and the new institutional architectures that analysts believe are paving the way to a $1 million Bitcoin. We're literally looking at how to make $1 million in crypto in 2027 based strictly on the data. So, right off the bat, we've got to address the elephant in the room. $1 million. Is the idea of Bitcoin reaching $1 million by 2027 just internet hype? Or is there actual hard math behind it? I mean, we constantly hear these massive seven-figure price targets thrown around on social media, right? But as focused learners, we honestly don't care about the hype. We only care about the underlying data. How are serious researchers actually modeling out this path to $1 million valuation? Well, according to a peer-reviewed academic model, this was published in the Journal of Risk and Financial Management, so not exactly a random Reddit thread, this target isn't just a wild guess. Their research suggests that exponential price growth could be triggered by a very specific collision, a mathematically fixed supply crashing head-on into massive institutional withdrawals. We're talking about a scenario where ETFs, corporate treasuries, and sovereign buyers are consistently pulling coins out of circulation, which creates a severe structural liquidity squeeze. So, here is our blueprint for today's explainer. First, the million-dollar crypto question. Second, the macro landscape. Third, the three-pillar portfolio strategy. And finally, managing risks for the future. Starting off with Section 1, the million-dollar crypto question. Decoding the supply shock. Okay, the absolute crucial point here is that unlike traditional assets, Bitcoin's supply does not and literally cannot expand when prices rise. Think about gold for a second. If the price of gold absolutely skyrockets, what happens? Miners are incentivized to dig deeper, they introduce more gold into the market, and that newly mined supply eventually cools the price down. Bitcoin doesn't do that. It has a mathematically hard cap of 21 million coins, period. Now, when you combine that fixed cap with the fact that spot Bitcoin ETFs have already absorbed over $95.77 billion in assets under management, and then you factor in that long-term holders and lost wallets are constantly draining liquid supply from exchanges, you create a very unique supply shock condition. Essentially, the available Bitcoin on exchanges is hitting multi-year lows right at the exact moment institutional accumulation is ramping up. And their equilibrium modeling paints a pretty wild picture. It shows that if institutions drain just 1,000 Bitcoin from liquid supply on a daily basis, we could actually see that $1 million price tag by early 2027. Think about that. And if withdrawal rates push to 2,000 Bitcoin per day, well, their projections push the target toward $2 million later that same year. The math basically shows us that when demand growth collides with this drastically reduced liquid supply, the asset stops growing based on gradual adoption, and it starts expanding exponentially based on sheer scarcity. Moving to Section 2, the macro landscape, we're looking at geopolitics, regulations, and RWAs. On the regulatory front, we are seeing a stark, undeniable global policy split. Impartially speaking, the data shows two vastly different approaches to the future of digital money. Over in Europe, the European Central Bank is really accelerating efforts toward a sovereign, programmable digital euro, and they're aiming for a potential first issuance around 2029. Meanwhile, the United States has taken the exact opposite route. With the signing of the Genius Act in July 2025, the U.S. explicitly rejected a central bank digital currency. Instead, they favored federally regulated, 100% dollar-backed private stablecoins. This divergence is huge. It means the infrastructure of global digital finance is physically splitting into two entirely distinct regulatory rails. But beyond just stablecoins, the macro landscape is really being defined by a massive pivot from the big institutions. They're flocking to real-world asset, or RWA, tokenization. If you're not familiar, this is the process of taking traditional financial assets, we're talking U.S. Treasuries, private credit, conventional stocks, and representing them as fully compliant digital tokens on a blockchain. The International Monetary Fund itself has noted that this isn't just some marginal efficiency gain. No, it represents a structural shift in global financial architecture. We're literally talking about traditional finance fundamentally moving its plumbing directly onto blockchain rails. And the sheer scale of this movement is staggering. I mean, by July 2026, the on-chain value of RWAs, and this is excluding stablecoins, by the way, skyrocketed over 400% to hit $33.5 billion. We are seeing major legacy institutions driving this whole thing. You have entities like JP Morgan processing over $1.5 trillion in cumulative volume on their blockchain platforms, plus you have these massive tokenized treasury funds drawing billions in assets. Make no mistake, this is the regulated institutional reality of the 2026 market. Which brings us to Section 3, the three-pillar portfolio strategy. This is the micro execution. So how do you actually position for this? Well, this blueprint breaks down a typical conservative allocation model derived directly from current analyst data. It's basically a three-legged stool. It anchors heavily in Bitcoin at 60%, treating it as the primary institutional asset. Then it utilizes Ethereum at 25% for infrastructure and revenue generation. And finally, it allocates a smaller 15% high-risk portion to AI and decentralized exchange altcoins, which acts as the portfolio's growth engine. Let's break down the logic behind each of these pillars, starting with the anchor. Look at these projected price targets from major institutions. This is what informs that heavy 60% weighting for Bitcoin. Standard Chartered, ARK Invest, and JP Morgan all project targets at or well over $100,000 for the near term. JP Morgan, for example, notes that Bitcoin currently trades near or even below its estimated mining production cost of $77,000. And historically speaking, whenever Bitcoin trades below the cost to actually produce it, it has signaled a major accumulation zone. This institutional consensus is exactly why analysts construct the base of the portfolio around Bitcoin. It is the anchor, specifically meant to capture the primary flow of ETF capital. Now, moving to the second pillar. Analysts argue that Ethereum is actually widely misunderstood by a lot of retail investors. While some people critique it for being a bit quiet in terms of explosive price action, the data shows it has successfully transitioned into a massive settlement layer, securing a $56.3 billion decentralized finance economy. It's literally a cash flow producing network. With over 37.5 million ETH staked by validators, investors are generating 3 to 5% passive yields. Furthermore, there are pending applications for Ethereum ETFs that could actually include these staking yields. If those get approved, it could fundamentally re-rate Ethereum in the eyes of traditional finance. They'd start seeing it as a true institutional-grade income asset, which makes it quite distinct for Bitcoin. And for the final 15% pillar, the focus shifts entirely away from pure money and settlement and moves toward a $28 billion AI crypto sector. Now, this isn't about chasing hype. Analysts are looking at decentralized networks that offer real, tangible machine learning compute infrastructure and are generating organic revenue. Plus, decentralized exchanges in this category possess what's known as high beta coefficients. That's a technical term, but it basically means that historically, these smaller assets act as multipliers of Bitcoin's moves. So if Bitcoin makes a significant percentage gain, these high beta tokens could mathematically multiply that return. But, and this is a huge but, this high reward comes with extreme localized volatility, which is exactly why analysts strongly suggest capping them at a much smaller percentage of the overall portfolio. Finally, Section 4, managing risks for the future, beta coefficients, and reality checks. So a critical mistake everyday investors make is falling into what analysts call the correlation trap. A lot of people still treat crypto as an uncorrelated safe haven asset, right? Like it's digital gold that's going to magically protect them if the traditional stock market crashes. Well, the reality is quite different. Current data shows Bitcoin holds up to a 92% correlation with the Nasdaq. 92%. This means that if you hold traditional tech stocks and you add crypto to your portfolio, you are absolutely not diversifying away from tech risk. You are actively amplifying it. Both will very likely fall together in a broad market sell-off. Understanding this dynamic is absolutely crucial for properly sizing your investments. All of this data really builds a timeline that requires patience. When we look at the chronological sequence of this market cycle, we can see that these massive macro shifts simply don't happen overnight. The 2024 supply halving, the 2025 regulatory clarity from the Genius Act, the massive 2026 surge in institutional real-world assets, these are all foundational building blocks. The kinds of liquidity drains required to actually hit a $1 million projection, they take years to fully bake into the ecosystem. Analysts stress that investors who are expecting overnight parabolic returns often completely miss the wider structural reality that is taking place on a multi-year horizon. So how do the professionals optimize for this timeline and all this volatility? Well, advanced backtesting models, like the peer-reviewed Talixian framework, suggest moving away from simple buy-and-hold mentalities. First, they focus heavily on the Sortino ratio. This measures robust downside risk, rather than just looking at general upside volatility. For deploying capital, historical data suggests a hybrid approach works best. It looks like this. putting 40% in as a lump sum during periods when Bitcoin drops below its mining production cost, and then using a steady dollar cost average strategy for the remaining 60% over a 6 to 9 month period. When you combine that with strict quarterly rebalancing, it forces investors to systematically buy low and sell high. It turns the crypto market's extreme volatility into a mechanical feature of your portfolio, rather than a bug that scares you into selling. And that brings us to the end of today's explainer on these analyst blueprints. If you found this breakdown of how to navigate the road to $1 million crypto market helpful, please do us a huge favor. Hit that like button, subscribe to the channel, and leave a comment below. We really want to hear from you. What does your 2027 portfolio strategy look like right now? And based on all this supply shock data we just went through, do you believe $1 million Bitcoin is mathematically inevitable? Or is there some variable you think these models are completely missing? Let us know, and we'll see you in the next one.